Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. Daniel Foch is a real estate broker working in the real estate industry for over 15 years. He and his team have transacted over $250 million in real estate across a variety of asset classes. He was an active instructor and contributor in the University of Guelph's real estate faculty. He was also a researcher there, and he hosts the Canadian Real Estate Investor podcast. So on this episode, we discuss the latest real estate news headlines like inflation in the US and its impact on the Canadian economy, recent OSFI changes. So OSFI is the Office of the Superintendent of Financial Institutions. These are Canadian changes that we'll be seeing over the next few months. Upcoming opportunities in the Canadian real estate market. So his opinion on what you'll be finding in the next couple months as well. And the NAR, National Association of Realtors lawsuit, that this was kind of a big thing in the US that's happening. And we kind of just broke down some of the changes there. And then finally, we talked about the recent TRESA changes. So these were some of the rules around open bidding in our market, so in the Canadian market, and how he's seeing that's impacting things as well. So I hope you'll enjoy the episode. If you do, make sure to leave us a review and make sure to share this with a friend or family member. Your support is truly appreciated. Reviews help us get the message out there to more people. So thank you for everyone who has left a review in the past and for all the people that continue to support us. And if you are interested in picking up some free reports that we offer, I would encourage you to check out the website. So go to www.welloff.ca/podcast, and there's a bunch of really cool resources that you can download there. So there you go. Enjoy the episode. All right, I'm here with Daniel. Second time on the show. I appreciate you coming back.
Yeah, happy to be here. Thanks for having me.
Yeah, so what's new, exciting, anything since we've last, I think it was about a year ago when we last spoke.
Yeah, I think last time we chatted, like Nick and I were just kind of getting started with our show, and I had mentioned to you prior, we just hit 1 million downloads, which is kind of a cool milestone. We launched like a course for real estate investors. We've been running meetups coast to coast, so I mean, it's been really cool. The community's been awesome. We're really grateful for what we've been able to build in that regard. I think that's really the only major update. I mean, I think, I've been listening to your show, and the market's interesting, but I feel like everyone knows that one now.
Yeah. Well, congrats on 1 million downloads. That's a huge accomplishment. I'm interested in hearing a little bit about the course. So How did that come about? When did you guys launch it, and how's that going?
Yeah, it's funny. We were really reluctant to do it. Like, I was always afraid to get into that kind of like guru space. And we just, like, people from our audience just kept asking us, like, would you do consulting or coaching or whatever? And our answer was like, just as often as possible, like, no, it's probably not something, it's not really on the roadmap, maybe in the fullness of time, but it just kept being requested. And it was like, okay, I guess we kind of have to do this at this point. So we just really responded to the audience. That's how it came about. And then we ran one cohort. We just basically did like a limited group, capped it at 20 people, offered it at a discount, and just said, like, what do you want to learn? We got a list. We, basically dove into all those topics in detail. And then since then, we've built it out to like hundreds of hours of recorded content where we kind of direct people to go and fill the knowledge gaps that they need. And then there's weekly calls. There's calls like every other day, pretty much. We have like Mondays are masterminds. So you just meet with other investors. Thursdays we do deal review calls. So we just go through we call it a deal workshop. So people bring in like a transaction, we run the numbers on it. We have regular expert sessions. So we have today we had a tax expert on because it's kind of tax season. So discussing filings and structure and stuff like that. We have lawyers come in to do, talk about closings and JV structures and pretty much everything that you'd need to know. We just really try and distill it down. Like, you could probably learn all of these things listening to our podcast over hundreds of hours, but if you don't have time to do that and want to distill it down into a kind of like 2 to 10 hour experience, then that's what it's for. Mm-hmm. Yeah.
So this course, the hundreds of hours of content, I guess people can listen to it at their own pace, and then they can participate in some of these other things that you're doing, right?
Yeah. Exactly.
Awesome. It's really cool that you've been able to take this podcast from where it was when we first started talking to where it is today. 1 million downloads, again, big accomplishment. So I'm sure that's been keeping you busy. Today, I wanted to dive into some of the headlines that we've been kind of seeing in the news, getting your opinion on certain things. I know you guys are into data and you do a lot of research and that sort of thing. So maybe the first thing that we can talk about was an article by CBC about the U.S. inflation and how that there was an uptick in February for inflation, and that's driven by higher rent and gas prices. So just get your thoughts on how inflation in the U.S. is going to potentially impact us, how that's going to impact the rate moving forward this year, that sort of thing.
Yeah, I think it's interesting more than just purely that it's inflation going up. It's the components of inflation, the fact that it's coming from rent and gas that is equally notable, because those are two things that can sort of become entrenched inflation, right? So when you discuss wages, or say rent, there's this idea that, and actually there's an article that just came out today in Global in Canada that businesses are having a hard time retaining talent because of the housing crisis, right? So wages, or if rent's going up, then people's wage expectations go up because they need to be paid more to be able to afford to live close to their job. So you get this phenomenon in economics called the wage price spiral. And I think that there's risk of that creating more inflation, right? So you have to pay people more, then you have to charge more for your goods, right? And people have more money. People with these increased wages have more money to spend on goods. And so it becomes this kind of negative feedback loop in inflation. So there's risk of that. And that can really start with rent. This is why governments make an effort to keep housing affordable. Mm-hmm. The next one is gas, which is sort of the same thing, right? It's obviously not with the human capital in the middle of it, but if you have to pay more for goods to be delivered to the grocery store or to the retailer, then it's going to cost. Those will eventually make their way into costs, and so fuel costs can very easily become more inflationary. And I think you're probably going to see this when they continue to ratchet up the carbon tax in Canada on April 1st, right?
Yeah, that's another interesting story. The carbon tax. I know that a lot of people have been talking about that. So yeah, this is U.S. inflation again. We're not going to like dive really deep into a lot of these topics, but just sort of get an idea of your thoughts. The next big one again from CBC is the Bank of Canada expects it will cut rates this year, but officials are split on timing. What should we be looking for? Because in this article they were talking about how they're obviously aiming for a 2% inflation, annual inflation. Last inflationary numbers that came out were for February, and it was at 2.9, I believe, or 2.8. So we haven't quite reached there yet. Do you think they're going to hold off on this until they reach the 2% mark, or what are your thoughts?
I think that they probably would. I would just defer to the first question that you asked. I think it really depends on the U.S. If U.S. inflation gets under control, then there's a higher likelihood that they'll cut. I can't see the U.S. cutting too close to the election, so they're either going to do it soon. I think the election's November, so they'll either do it soon or they'll do it right before or right after the election, because you don't want it to become politicized. I think Bostic from the Fed said he is only expecting one rate cut this year. I mean, their economy is still pretty strong. Like the U.S. has really been a juggernaut in that respect, and if inflation is still perpetuating, there's no need to stimulate the economy with lower rates. I think the Bank of Canada is really in a tough position, right? If they cut too early, then we're at risk of destroying the Canadian dollar against the US dollar, and with them as our largest trading partner, which is why all those things I just mentioned about US inflation matter in Canada, because if they're our largest trading partner and they're in an inflationary environment, if those goods go up in cost, then we'll feel it here. But similarly, if the Canadian dollar suffers as a result of us cutting way before the Fed, which, just for context for those listening, like the reason that would happen is, I mean, the easiest way to think about it is if our interest rate is lower, then the currency is less valuable, let's call it, because it's earning a lower return, right, than the US dollar. It's not that simple. Like that's an oversimplification, but that's the easiest way to think about it. So if the Canadian dollar gets devalued against the US dollar, then what happens is the currency that we're buying goods from them with becomes less valuable. And so the goods that we're buying from the US and US dollars become relatively more expensive. And you get this phenomenon called imported inflation. And that's where I think the Bank of Canada would really make an effort to avoid imported inflation. If you look at like past inflationary regimes like the 70s and 80s, inflation usually like peaked and then it fell off and then it actually hit a second peak, a lower one, but a second peak. I think they want to try and avoid that, obviously.
Yeah. Well, the interesting thing, so again, in this same article, they were saying that the goal initially was to have 3 rate cuts this year, right? And this is, I guess, in Canada. But it doesn't, I don't know, it doesn't really seem like we're going to get there. I'm not sure how that's going to happen, but that would be pretty cool to see those rate cuts from as a real estate investor. But again, it could impact things in another way, like you just mentioned.
Yeah, I mean, I think the market's very temperamental, and I think the flow of information is so powerful right now. Like if you think back to like even the conversation that we had on this show a year ago, people didn't really know that much about the role of central banks. Morgan Housel describes this in his book, The Psychology of Money, where he talks about, our generation really doesn't have a grasp or even a perspective on inflation because we never have lived with it, right? We've never thought about it before because we never saw it in our lives. The last time we really saw an inflationary regime was like in the late 80s. So all of that being said, like I think that the central banks are just going to tell people probably what they think that people want to hear, because it doesn't really matter. Like, I mean, the time for accountability in politics is, well, I don't know if it ever existed, but like, the central banks also told us that rates would be low for a long time. So who knows what we can trust from them? But the reality is, and this is the interesting part, I think that they'll never tell you exactly. It would be probably civil unrest or political upheaval if they told people the truth about what it would take to get inflation down, which is usually a recession. But I think that you see, and in some of the most recent pressers, like the central bank said that they're worried about, or the Bank of Canada said that they're worried about house prices reigniting if they drop rates too quickly, among other factors. These are all things that you can see in consumption in our profession, especially. Like if people think once there's a rate hold, the market rips for like a couple of weeks because people are optimistic, right? Yeah. They think, the rates are being held, cuts are next or whatever. As soon as you hear the government talk about cutting, market goes and rips for a couple of weeks, right? And so people are paying attention. They're realizing that people are paying attention. And I think they're trying to be very, very careful. And they almost I think they drip out this information to see what the response will be before they actually introduce the policy.
For sure. It definitely seems like that's the case. But then with that said, on the other side of things here, we just had this recent announcement that there's been changes to the OSFI mortgage regulations and whatnot. So this is all like pretty new to me, but it's apparently a new mortgage test. Not the same as a stress test, so it's a little bit different. But do you just want to share what you know about this particular change?
Yeah, so the OSFI stress test, the OSFI makes the stress test. They're the Office of Superintendent of Financial Institutions. So they're the ones who regulate Canada's chartered banks and non-bank financial institutions, but this only applies to banks. So what they did was they introduced this. Basically, they're going to cap the amount of mortgages somebody can hold in their entire mortgage universe. Their entire bank mortgage universe at 4.5 times income. Now, the reality is, right now, this policy doesn't really matter because interest rates are high enough that your debt service coverage ratios or your GDS and TDS ratios are what's actually causing the reduction in buying power, because your monthly mortgage payments wouldn't ever allow you to get to 4.5 times income in the current market, because your monthly payments are so high due to interest rates. So I think what Peter Routledge, who is the Superintendent of Financial Institutions, is likely trying to do is lean into rate cuts as rates start to come down into the probably 3 range, where this policy would actually make sense, where this policy would actually become effective. It would make sure that we aren't seeing that reigniting of the housing market that the Bank of Canada is worried about, and that it caps people from taking on too much leverage in sort of a shaky economy. By my estimates, it really only reduces buying power on the average borrower by like 12%. So it's not huge, but it's enough to shave off some of that risk that we don't end up in the same position like we were in 2022. Right.
Well, this seems like it's something that's specifically targeting real estate investors or people who have multiple mortgages. If you're buying your first property, this doesn't really necessarily impact anything, really, right? It's for uninsured mortgages.
Yeah, exactly. Yeah. It is funny, and like on the insured mortgage side, I know you're going to mention the CMHC, like the mortgage bonds and stuff, but it's funny because it almost just it incentivizes the banks to really just play more and more in that space, which is interesting because it could create some financial creativity outside of the bank space, like your non-bank lenders, monolines, credit unions, B lenders, right? To be more competitive in the investor space.
So just to put things in perspective, 4.5 times the income. So let's say you make $100,000 a year.
Yeah.
Does that mean you can only qualify for a $450,000 mortgage?
Correct. Yeah.
Yeah. Seems very challenging. I mean, if that's the case, but again, these are kind of challenging times at this point anyway, with regards to qualifying for mortgages. So
yeah. I think the point would be that people need to increase their incomes if they want to be investing in more real estate, right? I think that a lot of this is to kind of cap risk on banks' books with people who are like owner-occupied borrowers, but it's also to disincentivize people from taking on more debt to finance investments that are bad, right? Because if the investment's cash flow positive, then it should increase your income and therefore increase your ability to qualify to borrow it or to borrow against it, right?
Yeah.
But
so this is, I'm not sure if there's kind of data to support this or if we're just going to have a conversation about it, but one of the other headlines that I saw was kind of a suggestion that people should get into the real estate market sooner than later, because once they start cutting these rates, there's always that chance that the market's going to explode again. Would you, I don't know if you're not a realtor, right?
I am, yeah.
Oh, you are a realtor. Okay. Mm-hmm. So would you advise clients on doing that, or what are your thoughts on it?
My advice for clients would be the same as it always has been, like even in a ripping market, which is it's always a good time to buy a good deal and it's always a bad time to buy a bad deal, right? Like you can't really time the market, and I think a lot of people try and offload the task of finding a really good transaction onto the market, right? And hope that the market will remove all of the risk associated with that. But the reality is, it's like you look at large private equity groups or institutions, expert investors, developers, et cetera. They have full acquisitions teams whose job it is. They get paid hundreds of thousands of dollars, if not millions of dollars a year, to buy properties well. Like, that's really all you need to do. And hiring a realtor who is functionally your acquisitions team, who's a really, really good professional, who's going to help you get a good deal, is the best hedge against a good market, risk in a good market or a bad market, right? If in 2022, in the run up, if you weren't getting good advice, then you were exposed to risk. Same thing in today's market, or if we in a down market, or if we see a resurrection of prices. Doesn't mean you can't. There were still in the peak of 2022, there were still wholesalers going and buying deals at 100, $200K under asking or under market value, right?
I was just gonna actually mention that, because back in 2020, 2021, when things were going up 30% a year, a lot of wholesale deals that I would see were selling over market value. Like, right. I'm not sure if you were following that, but I would just look at these prices and say, this doesn't make any sense. I can literally buy something on the MLS right now for cheaper than this dilapidated house, right?
Right.
So it goes to your point. You really got to know what you're doing, and you can't just assume that it's a deal because a wholesaler is bringing it to you. You've got to have somebody, either yourself or someone on your team, that's doing that research to buy well.
Yeah.
Another interesting thing, kind of related to this whole OSFI stuff, So one thing here, it's we have about 220 billion of mortgages with amortization periods longer than 35 years. This is in Canada, I believe, in the entire country. So the amortizations have obviously increased, and this is hugely in part of because of all the refinances that happened during the pandemic and whatnot. Because apparently 50% of mortgages during that time were variable.
Yeah.
Right. So that increased substantially. And now with these variable rates, like RBC, CIBC, and BMO, I think, offered the static variable. So your mortgage payment doesn't change, but your amortization changes. And that's why we're seeing this extended amount now. How do you think that's going to kind of play out and impact things moving forward?
Yeah, I think it really depends on the rate path. Like, I think this is where, so if I were to guess, I would say that we're probably going to see fixed rates come down to like the 3-4% range next year. Like you'd be able to get rates in the mid 3s, low 4s maybe. I think the central bank is aware of this renewal wall that exists, right? There's the highest number of mortgages that we've ever had in Canadian history come up for renewal in 2025, 2026. I think it's over a third of the mortgages outstanding, or maybe 2/3, because of what you're describing. Not just the refinances in 2021, but also 2021 was a record transaction year. In 2021, we saw on Toronto Real Estate Board like 121,000 sales. 2023 we saw 67,000. Yeah. Right. Just for context, this year they're estimating we'll see just shy of 80,000. So. You had a ton of acquisition, people buying at inflated values, really, against today's market. You saw a lot of people refinancing to capitalize on the lower rates. Didn't work out well, and that's a ton of risk from my perspective. I think that the Bank of Canada is really going to make an effort to get rates down before that, and I think a lot of people think, that rates are going to come down, the market's going to rip. It's like, well, all those people who bought, even on a fixed at like 1.5, 1.6, 1.9, whatever, even 2s. If you're going from a 2% rate and refinancing at a 3.5, your capital cost is almost double. It's not cheap to, so I think that we're going to see, like, regardless of what happens, I don't think the Bank of Canada can get rates low enough to save a lot of the people who are coming up for renewal in 25, 26. Yeah. So to me, that's a lot of potential supply that could come into the market.
Is it surprising to you, based on a lot of the research, it seems like not too many Canadians are in trouble, even with the higher rates. And it seems like they've been pretty responsible overall. Most people have been able to make their payments and adjust. So again, is that surprising?
I think that it's a data point that I don't really trust. And it's not like I'm being a conspiracy theorist about this. Like, you don't really have to pay your mortgage with the banks. Like, and it says that in the Canadian mortgage charter that they came out with. I mean, like, that's not financial advice, by the way, like, pay your mortgage. But if you don't, there's a whole list of things on the FCAC website that banks have to do to accommodate you to, like, if you're going to show, so if we think about mortgage delinquencies, they were at record lows. They're climbing now quite substantially. They're up like 135% on a year-over-year basis, but still like below 1%.
Right.
So
super low.
Yeah, I mean, it is super low, I suppose, but banks only have to report mortgages that are 90 days delinquent. Okay. So that means that somebody hasn't paid their mortgage for 90 days, 3 months. So they've missed 3 mortgage payments. During that 90-day period, they would tell you to put your house up for sale. They would offer you some sort of payment plan. All of these different ways to try and work out so that you don't show up as a data point that's 90 days delinquent. So you would almost have to be deliberately avoiding them and all of the options that they've given you to show up as a delinquent mortgage. Right. So it doesn't surprise me that mortgage delinquencies are low. What I would probably be looking more at is credit card debts are skyrocketing. Household savings are falling off a cliff. Auto loans are going delinquent.
So where does all this data come from? Like, how do they track household savings? I'm just.
So I don't recall who tracks household savings. I think it's Statistics Canada, actually, through the banks. Mortgage delinquencies comes from the CBA, Canadian Bankers Association. Right. The business bankruptcies is another one that I would look at, which is basically looks like a hockey stick graph. We haven't seen an increase like this since the 1990s, which is a horrible time for Canada. That one comes from the Superintendent of, it's not bankruptcies, they call it something else. But then the credit card delinquencies and auto loans comes from Equifax, actually, which would make sense, right?
So it sounds like for the banks, they have access to these stats, or they share these stats with the government, and that's where a lot of that comes from. So, all right, it sounds like we're sharing a lot of kind of negative things about the economy. We're heading in a bad place, but that's not necessarily the case for a lot of people that are listening to this, right? I think there's a lot of hope for investors because we are expecting rates to come down. So this is the first time in about 2 years where there's some good news on the horizon. I think for a lot of people that have survived to this point, they're going to be in a better position very soon. Would you agree with that?
It depends. I mean, I think existing investors. So I think the good news is that there are better deals coming, right? Like distress means that like the activity that I've seen from clients that we have in the private equity space looking to purchase developers or buy distressed debt in Canadian markets is like something I've never seen before. So people are attentive to the fact that good transactions can take place in bad markets. I think that's probably the opportunity for investors. Like, yeah, I hate to be the doom and gloom guy, but the reality is, like, for those people who were patient and waited for it, there's a ton of opportunity. The most opportunity. You look at all the best real estate investors in history. Sam Zell, his nickname was literally the grave dancer, right? He made all of his money during economic downturn. So I think that's probably piece number one. Piece number two, like, I think there's already been amazing concessions made to support investors. So I think rates are a very difficult one to factor into your investment thesis moving forward. Like, if you're already in a bad position, if you're cash flow negative or whatever, you've been holding something that isn't really technically an asset from my perspective for a while. Like, I don't call that an investment. That's a savings vehicle, or that's a liability if you're paying money into it every month. And so usually the best thing to do is to sell or reposition that. But the repositioning is where we're seeing a lot of opportunity arising. So you see the government, the Ontario government passing Bill 23 or proposing Bill 23, which allows duplexing plus garden suites on all single family residential lots in the province of Ontario. I mean, if you have cash, that's a no-brainer from my perspective, right? To multiplex a house and put a garden suite in, and now all of a sudden your assets on side. Like, opportunities like that are real ones, I would say. I don't know if hope or waiting for rates or an improvement in the economy is an exceptionally good strategy. I guess that would be my only advice there.
Well, yeah, for sure. But if you've had like a $200 negative cash flow in the last 2 years, and now you're expecting the rate to come down hopefully by 1% or so in the next year, well, that's going to bring you back to a cash flow positive or break even position, right? That's what I mean. You don't have to be out of pocket anymore, and to put in that $2,500 a year out of pocket isn't the end of the world for a lot of people. So that's more what I was saying. But I agree with you. If you're bleeding $1,000 a month or $2,000 a month on a property, and you're just praying that it's gonna come back to a neutral position, then you might be better off just liquidating that asset.
Yeah. I guess a lot of people just haven't done the math. Like, how much of a decrease in rates do you actually need to be cash flow positive? Because if it is, like, if you're $1,000 offside, then 100 basis points probably isn't going to save you, right? Exactly. If you're $200 offside and it's only been a year, and you can be $200 onside for the remaining 3 years of your mortgage, yeah, I mean, okay, that's a different situation, right? But yeah, if these are things causing you financial stress, like you can't discount the psychological cost of it, like the psychological burden as well of constantly stressing to shuffle money around to pay a cash flow negative asset, like those things are taking away energy from you being able to do, maximize your earnings or make other income or whatever. So,
well, I think the majority of the investors that I've spoken to have had to shuffle money around just from their, especially if they're active, they own a substantial portfolio, then they've had to make some adjustments because, if you're growing quickly, you've had to leverage, you've had to use a HELOC or something to grow. And that's just the reality of the situation. Most people that are growing, that are kind of on these podcasts are people that want to grow. And it's more so that person that has that one investment property that's probably been really okay and comfortable the last couple years, right? I would say, in my opinion. But I do agree with a lot of the things that you're mentioning here. Any other points on this this topic?
In regards to like current opportunities, rates coming down, et cetera?
Yeah.
I think that we've seen a lot of, like, I think COVID, but also the population growth in Canada and this like sort of sobering economic reality with higher rates has made people realize that like there's just a lot of opportunity outside of the Ontario market, or even in like just smaller like second tier Ontario markets. It's nice to see investors actually pursuing things like cash flow and, not just basing investments on purely speculative like capital appreciation. So I think that this is like a little bit of a healing moment for me, from my perspective, where people aren't like, I think that Canada really, we have begun to come to our senses very quickly in regards to what actually makes a real estate investment an investment and what makes one a speculation.
Sure.
Yeah.
You did mention Bill 23 a bit earlier. I'm not sure how much information you have on this. Obviously, you're not an expert on this particular topic, but I'll ask you, or maybe you are actually. I don't know. There's been a lot of municipalities that haven't yet adopted all of the changes that were implemented through Bill 23.
Yeah.
Do you know how that works? Like, how is it that, I guess I don't know if it's the province or if it's a federal bill, they implement this change, but then the municipalities can take their time to apply it?
Yeah, so the way it stands right now legislatively, from my perspective, and I've asked this question to a number of planners, is basically that the province, so the only way that the province can enforce something like Bill 23 in the way that you just described, like is through the Ontario Municipal Board, or LPAT, I guess, which is where if the municipality rejects an application, you can take them to this board. It's like a court to fight them on their decision. And they basically said, we're going to blanket approve all of these. So if a municipality ends up in front of us for one of these Bill 23 things, for somebody trying to duplex or add a garden suite to a property or an accessory dwelling unit to a property, then they're guaranteed to win. So don't bring us these things, because it's a waste of taxpayer resources to have a municipal government fighting the provincial government on something that we've said is allowed.
Right.
And so municipalities approve them. They can make it hell to approve them. And if they don't approve them, you could say, okay, let's go to the Ontario Municipal Board, and you would win. And you would likely be able to collect damages for the legal time that was wasted. This is how it's been explained to me. And there's a couple planners I could recommend actually that you maybe have on your show to discuss it, because there's some other big changes as well, like in the city of Toronto, where like even on the topic of opportunities, like I think fourplexing in the city of Toronto, it's probably like the first time Toronto's been investable, right?
Right. Yeah.
But yeah, so that's my understanding of it. There's another guy actually he's like probably the biggest, it's his goal to become the biggest garden suite supplier in like the city of Hamilton, as an example, who's really familiar with this stuff. But yeah, basically the municipalities they have no like legal defense to fight you at a provincial level.
Yeah.
And so they're not rejecting applications. I think that most of them just haven't built the best practices to get the applications processed. So in a lot of cases, it's like, as an investor, you're trailblazing, right? You're like the first person through the process. So it can be painful, but I think if you're willing to work collaboratively with the municipalities and everyone's on the same page, then it'll be rewarding in the fullness of time. Yeah.
Well, I have an example which I've touched on in past episodes, but I've got a townhouse in Welland. It's an end-unit townhouse with a detached garage, and I've already got an approval to build an accessory suite within the existing home, so it'll turn it to legal 2-unit. Mm-hmm. And then I had a designer reach out to the planning department, the Welland planning department, to put in a garden suite to convert the garage into an additional suite. And they said, no, that's not allowed right now. But Bill 23 says that it should be allowed. So I'm in that exact situation. However, the planner did say that moving forward later this year, they will likely make the changes on their end. So it's like one of those situations where it's not really probably worth fighting on my end and spending money and resources to get that change, to force that change earlier, when I can probably just wait a couple months and it'll happen on its own.
Yeah, I think that would probably be wise. I think that the Ontario Municipal Board is like similar to the Landlord and Tenant Board, where it would take you a long time to get a hearing. So I'm sure you could be an asshole and threaten them, and but the reality is, if they're already going to change it anyway, it probably isn't going to serve you very well to make an enemy of them.
Exactly. Cool. So that's the final, I guess, point on that particular topic. Another thing, so the NAR or NAR lawsuit.
Yeah.
So for anyone who's not familiar, maybe you can just kind of give a bit of a breakdown. I'm also curious to know. I don't know much.
Yeah. So basically, the public, or as a class action lawsuit, sued the National Association of Realtors and a handful of different brokerages and trade organizations in the States, basically implying that there was price fixing on buy-side commissions, and that the sellers shouldn't, or that listing brokers shouldn't be the ones paying the buyer agent, because then they're able to set the price. And so now the legal mechanism to pay a buyer agent is actually the seller would have to pay them directly, or the buyer would have to pay them directly. Somebody would have to pay the buyer's agent directly rather than the listing brokerage. And so we have a copycat lawsuit here in Canada. It's existed since that one launched. It's against the real estate boards in Canada, and then several of the trade associations. I get asked about this one a lot, and I think it would surprise me to see the lawsuit succeed in Canada. Now, that being said, NAR is like the biggest lobbying group in the U.S., and it's still, the lawsuit still succeeded there. So it would be, I just think that our economy is very dependent on the real estate profession and housing. And I also think that our justice system is just a little bit different. I won't even say it too critically, but it's a little bit different than the U.S. And so it would surprise me to see the same verdict here. But if we do in Canada, I think that the outcome would be the same. And Canada's a little bit different because I don't think there is as much collusion. Like, it's a very saturated profession. There's like 70,000 realtors in the GTA, on the Toronto Real Estate Board. We're already seeing like a lot of creativity on the commission side that's advertised explicitly, right? Kickbacks or 1% listing side or whatever. And that wasn't really taking place as much in the States. So I think buyers and sellers have more options here if they want to find a good price. I don't think it is as much of a collusion thing as it would have been implied by the lawsuit there. But I think regardless, it opens the door. Like, I think that there is a line in history here that the real estate industry was very different before this took place and after. And I think that it's really going to open the door for a lot of creativity, I think from a tech perspective especially, to see a reduction in the fee structure in our profession, and also probably an improvement in the quality of service, hopefully, and almost like an improvement in the representation environment. And TRESA, the Trust in Real Estate Services Act, seemed to be designed with an awareness of this lawsuit in mind. And the Canadian Real Estate Association has put out statements that they're monitoring this really closely. So I'm interested to see how it transpires. But I think I'll leave it with this, because I know I'm getting a little long-winded here. But I think that 2021 was probably the peak number of realtors. 2023 probably would be the peak number of realtors, but like 2021 would be the peak number of transactions that we will ever see in Canadian history. I think as housing becomes less and less affordable, more and more people can't buy, so there's fewer and fewer transactions, less and less realtors. I think you're going to see an increase in the number of transactions per realtor and a decrease in the number of realtors, because it's becoming less and less lucrative to be part of the profession. It's becoming a very hard profession now as a result of just transactions basically being cut in half, the total dollar volume being cut in half. And so that would be my prediction of like the outcome of this, irrespective of what happens in the legal proceedings in Canada, is that the real estate profession is now in contraction, and technology is only going to accelerate that.
Yeah, that seems to be like something that's often discussed, and people have different opinions on this. But I wanted to go back to the TRESA thing as well. So these were changes that were implemented late last year, and one of the main things was open bidding, right? So you can have a seller if they're holding offers, whatever, they have an offer date and they get 10 offers. Well, in the past, you weren't allowed to disclose what the dollar amount of the offer was and create this competition with people. You would have to just kind of, as a realtor, you would have to say like, hey, just bring us your best offer, that sort of thing. But now with these rule changes, you're allowed to actually disclose the price if the seller gives you consent to do so. Have you seen any data on how that has impacted things, or do you have any information on that at all?
Yeah, it's interesting. We did an entire episode on this on our show in comparing the Canadian market and the Australian market, because Australia has had open bidding for a long time, and both markets are in the state of housing crisis and lack of affordability. So I don't think it necessarily, like, there's two different things. You really just apply game theory here, like almost like economic game theory. So it's basically the idea that in either bidding scenario, you can arrive at an irrational price. In a closed bid, it's because you don't know and you have to guess too high. But in an open bid, let's assume me and you are trying to buy something, a house, and I know I'm willing to pay $5,000 over what the market value of the price is, because I love this house and I'm willing to overpay for it. Like, I know that I'm paying too much money, but I'm okay because it's just $5,000 too much, right? We both know the house is worth $1 million, and you're willing to pay $5,000 over market value as well. You love the house just as much. If you see that I'm willing to pay $1,005,000, now all of a sudden you know that the market value of the house, because there's somebody who's willing to pay, is $1,005,000, and so why wouldn't you pay $5,000 more than the new market value, which is $1,010,000? And then it creates this infinite feedback loop where, as long as somebody's willing to pay slightly over the new market value of the home, which has been established by the other bid, then it could equally accelerate. So there's a really good economic paper on this. I can't remember the name of it, but we referenced it in that episode about game theory and open bidding versus closed bidding.
Right.
Yeah. I don't think it'll have a material impact. I think it eliminates these like one-off examples where there's an agent who ill-advised their client, or a client who put in a horrible offer and completely overpaid for a property, and they didn't need to because the other bid was at asking price and they paid 20% over. Like, getting rid of some of those, and we've all seen those examples. Getting rid of some of those, I think, will help. Like that, and a lot of that should be done by our profession, proper training, etc. But it's not, and so the fact that those negative externalities still exist would hopefully be eliminated by this if it's adopted.
In my opinion, I don't think the open bidding is going to impact things that much, because from any homes that I've sold where we had multiple offers, I would say probably like 60-70% of the offers that we got were way lower than the rest. And then you typically have, a couple, like maybe 2 or 3 offers that are way above the rest, right? And those 2 or 3 would be really close. And often, you tell like an agent, just tell your clients to bring their best offer. They say we're not going to improve from here, or we will. Then one offer separates themselves from the rest, and then you always get these calls like, "Hey, we would have spent that a little bit more. We would have gone there. Why didn't you tell us?" That sort of thing. So I'm not sure if people necessarily would do that, or
well, it's so easy for people to say that in hindsight, like now that they know the price. Right. It's like, oh, now that you know the price, you're willing to pay the price.
Yeah, exactly.
Of course, you're willing to pay market value. Like, it was a guessing game at that point.
Right? So anyway, time will tell if what kind of impact it has. But again, like you said, I don't think it's going to have a major impact on the market. Maybe final thing to discuss. So mortgage bond issuances are up 50%, I think you were saying? Yeah.
So the government basically in the fall economic statement mentioned, actually I think it was before the fall economic statement, if you just Google like 20 billion Canada mortgage bonds they made this announcement that they were increasing the CMB issuance from 40 billion to 60 billion, with the goal of getting more housing built. So primarily through CMHC. So CMHC does two functions. They insure owner-occupied dwellings. So people buying with high loan-to-value mortgages. If you hear somebody buying with less than 20% down, they're buying with insurance. Regardless of who the insurer is, that gets packaged into Canada mortgage bonds and sold off. That's how the insurance works. The market buys the risk. The other product is that they also insure multifamily loans through MLI Select. MLI just stands for Mortgage Loan Insurance, and they do it on select projects if they fit Canada's housing goals. So affordability, accessibility, and environmental friendliness. MLI Select, I'm sure a lot of your listeners are familiar with it. It works for 5+ units. If you're building them, if you're converting or improving the energy efficiency of a building by 40%, as well as a couple of other things. And so they created this new capital pool to insure, or to allow for the insuring of $20 billion more of mortgages. The challenge is that they also committed to becoming the largest purchaser of those bonds that they issue and insure, which is you never really see a sovereign purchaser. You never really see fiscal policy. So the government, monetary policy is the Bank of Canada buying bonds. Fiscal policy is the Canadian government buying bonds. If the Canadian government is buying these bonds, this would be comparable to like Fannie and Freddie in the 07-08 crisis. They're usually doing it to support liquidity in the market because there might not be enough purchasers for those bonds. Or if there were purchasers for the bonds, they would be willing to pay such a low price that it would increase the yield, much like a cap rate. I'm sure your listeners are familiar with a cap rate. Price and yield are inversely correlated, right? So if you pay more, your cap rate goes down. If you pay less, your cap rate goes up. If the income stays the same thing. It's your yield, right? And so if the government's buying them at whatever price, keeps the yield down, right? So it's technically a form of yield curve control. So they're actually trying to artificially suppress interest rates for insured mortgages. If I was the government, I don't think it's a brilliant economic policy. I think it's a sign that things are not that good. But if all of this goes to building apartment buildings through MLI Select, CMHC MLI Select, that's great. If all of it goes to helping first-time home buyers buy or become buyers in the market, then that would be pretty inflationary from my perspective and just exacerbate the housing crisis situation that we're in. So that's kind of my thought on it. If all of it's going to housing creation, that's great. If all of it's going to first-time home buyers buying houses with insurance, and a portion of it will end up there, but that could be a little bit scary.
Interesting. Yeah. There's so many different moving parts in the economy. I wasn't even aware that the mortgage insurance, like CMHC insurance, is sold off and absorbed by the market. So is it like publicly traded or? No,
bonds are, I guess, not.
It's just through
traded.
The bonds, right? So,
yeah.
Okay. So when you're purchasing
when
you're purchasing a Canada mortgage bond, then you're basically the money's going directly towards, I guess, a pool of homeowners or whatnot that have mortgage insurance, right? That sort of thing.
Yeah. So basically what they do is, the selling of the mortgage bond is like the mechanism. So they insure, so CMHC insures against those losses, which makes which makes buyers willing to buy those mortgages because there's very little risk, right? Like the risk would be that the CMHC would have to cease to exist. Right. So what they do is they take all of those bonds, similar to like you've seen The Big Short. Yeah. So in The Big Short, they take all of these debt instruments, CDOs, they call them, collateralized debt obligations, very similar things. They have CMBs in the US as well. They take all of these mortgages, my mortgage, your mortgage, all of our friends' mortgages, and they package them, and then they cut that back up into all of these different bonds. And so your box, they make sure that they're all equally risk weighted and everything, and it doesn't matter because they're all insured anyways. And then you can buy a bond that is a function of that package of mortgages for $1,000 or whatever.
Right.
And it gives you a yield, which is what the mortgage borrower is paying, the interest rate, less whatever the bank spread is.
Right. This is so much to wrap my head around. It's it's hard to totally understand it within a couple minutes here of just chatting with you. But I think there's a lot of good information here for people to digest. Do you feel like there's any final points you want to touch on before we wrap things up?
Not really. I mean, my advice for people would be that typically, like if you look at the market, the economy usually is at its worst when rates are getting cut. Like if you just go back and look at every single rate cut, usually the bad stuff happens after that. And I know I probably just sound like a negative Nancy on here, but just look at history, right? And so there will likely be an opportunity when you're buying in a low rate environment and the deals are very good. And I would encourage people to be patient and wait for those periods of time, because I think probably a once in a lifetime acquisition opportunity is coming for real estate investors of our generation.
So we saw a dip in real estate prices over the last 2 years. Mm-hmm. You think there's going to be a further dip just based on historical evidence?
Yes and no. I would be surprised if we saw prices come down substantially further than they have. I think that it's like, it's a very tough thing to time, but it doesn't matter what the market value is, or sorry, what the average price in the market is, right? What matters is if you can find a good deal. Mm-hmm. Like I'm seeing deals that are incredible happening every single day in this market because there's distressed sellers, or somebody's stock portfolio just blew up, or their crypto and they had to sell off this asset to cover their losses or whatever it is, and they're in a hurry. And so you can capitalize on other people's, one man's trash is another man's treasure, right? We're in the type of market where those situations exist. It's not massively oversubscribed. I don't think that, I think a lot of people want to make it sound like the market's ripping and everything's going into a bidding war, but there's properties sitting on the market that are good deals. Like we're looking at buying stuff regularly, right? Mm-hmm. That is what comes with a recession. It is completely independent of average price, median price. You know, I would say price will probably be sideways for 2-3 years. It might grow at inflation, 2%, whatever. Mm-hmm. That's a healthy market, really.
Yeah, exactly. Yeah. Cool. Appreciate your knowledge on all these different things.
Hey, my pleasure.
Just to finish things off, do you want to tell people how they can reach you and any type of services that you're providing?
Sure, yeah. You can reach me at just Google my name, Daniel Foch, F-O-C-H. Google is usually pretty good at putting the platform that you would want to find me on in front of you. Service-wise, whatever, just give me a shout. I'd love to help people in the real estate space, and love to chat. If you want to check out our podcast, that would be great. And just follow me on any platforms if you're interested in what I have to say.
Awesome, Daniel. Thanks a lot once again, and look forward to staying in touch.
Thanks.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.